All right. Good evening, everyone. Welcome to the Loan Officer Training Series here with the Mortgage Calculator. We will get started in just a few minutes. I see some people already were commenting. Feel free to drop a comment. We pulled the comments there up on the screen, so feel free to drop a comment as you tune in. And we'll wait just a couple of minutes to get started. That way we can go live on all the different platforms, and we're giving everybody a chance to jump on as well. Remember that we do these loan officer training series every Tuesday night at 7 p.m. Eastern and every Wednesday night at 7 p.m. Eastern time. So definitely make sure you're tuning in every week. We do different topics every week. And this topic, just like you see on your screen, is going to be for purchase pre-approvals. But again, everybody just hang tight for us, waiting a couple minutes here to get started. Hello, everybody that's dropping comments there in the chat. Appreciate it. All right, it looks like we are good to go, so we can get started. We'll go ahead and take off the comments there on the screen, and then we will get it started. All right, welcome everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM loans, and we do our loan officer training series every Tuesday and Wednesday at 7 p.m. Eastern time. Now, we do a different topic every single week, and this week's topic, is going to be pre-approvals. So purchase pre-approvals. We're going to go through those between today and tomorrow as well. So I'm going to turn it over to Jose, our sales manager here. He has 27 years of experience, both as a realtor and a loan officer. And so he has a little presentation he's going to pull up, I believe, and we can get into it. So take it over there, Jose.
All right. Good evening, or for some of you, maybe afternoon, those MLOs of ours that are on the West Coast. Welcome to Tuesday night's training, where we're going over completing the purchase pre-approval. Now, this is a topic very important to us here at the Mortgage Calculator, because we love to be very thorough in what we do. We pride ourselves as being loan consultants and not application takers. That is basically a philosophy, let's call it that will lead to much longevity and sustainability in your professional career. Those are all very important topics right now, because when you all consider how many licensees there are out there, not everybody is a professional. Most of the people out there, I'm going to tell you, are quote bots and application takers that do not know how to add value to the transaction. All they know about is just talking about rates, but when you start taking them out of their comfort zone, when you actually have to provide solutions, they fall by the wayside. And that's where we at the Mortgage Calculator shine, because of our thorough and complete approach to providing a pre-approval, especially for a purchase. You know, the purchase market, very, very, very competitive. We're still having serious inventory issues, right? In other words, lack of inventory in all the major markets. So much more importance, it definitely raises the bar on needing to get thoroughly and properly pre-approved.
How many offers did you get on your listing you just sold, Jose?
Oh my God. I think we had like 30 offers. We just set up 2 days of complete showings where the wife, who's the agent there, was at the property. And I'm telling you, almost every offer was above list price. But then they really had issues when they came to the pre-approvals, because believe it or not, in 2023, I still received some offers without a pre-approval. You know what happens with those offers when you have all these offers coming in? those go into file 13 very fast, the waste basket, the circular file. Because what are you going to do? You got all these offers, and a lot of them look the same. They're all coming in above list price. Who has time to be chasing after everybody? Say, hey, you didn't send me a pre-approval. I'm thinking, if they didn't send a pre-approval, maybe they didn't have one. Maybe that's an agent that was actually working with somebody without making sure that they were pre-approved. Now, that would not be a very good agent. I wouldn't want that to be my agent in this very challenging time to land a property. I mean, now more than ever, your buyers, which are your borrowers, are reaching out to the top level of professional to help them compete, because this is a competition right now to land the listing, to land not the listing, to land the deal, to land the contract. It's not like, a buyer's market, it's a seller's market, and the sellers know it. So that's why we at the Mortgage Calculator do real pre-approvals. We do not do pre-qualification. That word just, I don't like it. I don't like it. Pre-qualification means nothing. Really, it means absolutely nothing. It means, to me, when somebody tells me pre-qualification, somebody in the biz, I start thinking in the back of my mind, that person's lazy. They don't want to do their job. They're really doing a disservice to their borrower in not doing a pre-approval. Now you're wondering, but Jose, what does that mean? Is in a pre-approval and a pre-qualification the same thing? Well, obviously not. Some people think that pre-qualification is just it's the easy button. It's really the easy button for some loan officers, and this is not a time to be clicking on the easy button, because the easy button is not going to get you the deals, right? Pre-qualification is basically worth the paper that is written on, and that's about it. Because in a pre-qualification, you do not go in depth and actually, like the phrase says, pre-approve the borrower. And the pre part to this equation is only because you haven't consummated the purchase, right? You don't have the fully agreed to contract, and you haven't submitted then the file with that actual property address and with an appraisal to get your final approval. But you have vetted credit, income, and assets, right? And you have to make an assumption on the property value. But I'm getting a little bit ahead of myself here. So what is a purchase pre-approval, right? I mean, I got into it there, but it's basically, you're like I was saying, you're doing a preliminary evaluation of what that borrower can actually qualify for. And at the Mortgage Calculator, we are not a cookie cutter company where we just try to fit everybody into the same mold, sometimes chopping off pieces just to make sure that they fit into that mold. Because in the end, when you do that, you end up with shortcomings, right? You're trying to fit, like I like to say, that square peg into the round hole, because you don't have other options at your company, so you're just trying to wing it. That's not the way it works. You have to do it's thorough job. So purchase pre-approval is definitely the first step, is the very first step to your path of home ownership. And like I state there in the third bullet point, and I was getting into now a second ago, a pre-approval is not a pre-qualification. Qualify, see what you would theoretically qualify for. But in the pre-approval, I am approving you for your, let's say, for your pre-purchase, right? You are, in my eyes, will be approved. When you're done with one of our pre-approvals, you are approved. And the only thing that's really going to keep you from getting that final approval is if you don't land a contract, so we don't have anything to submit, or if somehow or another I made an error in my calculations of the income, if we're talking about an income-based program or a DSCR program or whatever it is, and the numbers don't jive. But other than that, in our pre-approval, you are approved subject to getting the property and final underwriter review of the documents that we reviewed, because we're not winging it. We're gonna run it through the full application, right? Full application in Encompass. The docs are going to be requested from the borrower, the same docs that are going to be requested to submit the file to underwriting. You are pre-underwriting that file. That is your job. Now, again, if it's a agency loan where automated underwriting is going to come into play, then you're going to be having the assistance of AUS tell you yes or no, but you're still going to have to put in the data and interpret the data that you input into the file. And if it's if it's non-QM, you are the DU, right? You're going to be the filter, as I like to say, to review all of the information and see what is correct. So why would a borrower want to get pre-approved? I mean, I don't know if I really need to answer that. It's almost like a rhetorical question, but still, we like to reinforce, all the major benefits, like we were just saying right now. If you want to get the house in this very challenging, limited inventory environment, you have to get pre-approved. You just can't be out there winging it and hope to get lucky and land a deal without being pre-approved. So first and foremost, if you want to get the house, you need to get pre-approved. But on a more general terms, it definitely allows you to plan better, be able to budget for your purchase. You don't want to be looking at $1 million houses and have, like they say, champagne taste and beer budget, right? You're looking for the $1 million house, and then all of a sudden, when we get the contract approved for $1 million, and all of a sudden you're like, okay, well, I didn't know I was going to need that much money. I thought the bank would just lend me the money, right? Because you're you, right? No, there are guidelines to follow, considerations, down payment, credit requirement, asset requirements, a lot of things that come into play that you have to take into consideration so you could budget and plan accordingly. And when we're talking about if you want to get the house, you'll note there listing agents. I put there generally because I guess I'm trying to be nice, but in the real world, listing agents are going to require an offer be accompanied by a pre-approval. No pre-approval, like I said, that's going to go into the circular file. Good buyer's agents are also going to require the buyer to be pre-approved before showing them properties. Can you imagine you're driving all over town? My town's pretty big, so it could be a lot of miles. And then you have somebody that doesn't have 5 cents to their name. And then you wonder, and then some people would ask the buyer, but why were you even looking at houses? No, you should first ask yourself, why were you even showing them houses if they weren't pre-approved, right? That's when you reach out to your MLO partner. Joe Realtor calls me and says, Jose, I got this guy. He wants to look at these mansions, but I don't know. Please pre-approve him for me. Which, in saying that, actually, there's a security component, actually, of getting pre-approved as well. Because for a realtor, especially realtors dealing in these very exclusive properties, they want to know that who that buyer is. They don't want some thief coming into the house to scope out the property, and what they're really doing is just seeing what they could steal. No, they know that when you're pre-approved, you've checked ID, you've checked assets, you've checked credit, that person really exists. So that's a component that most of you may not consider for pre-approvals. But when you're dealing with a certain profile of property or a certain profile of seller, they're going to require that you vet everybody that goes through that property before they step one foot into the property to make sure who they are and who they're not. And of course, like I mentioned earlier, it saves time knowing the amount that you actually qualify for, because again, we don't want to have that champagne taste and beer budget situation happen. We want to know from the beginning, this is what it is that allows us as the licensee, whether we're the mortgage loan originator, as well as a realtor, because typically we're going to be working together with realtor partners, right? And this is a great time if you have a buyer that wasn't referred to you by a realtor partner. This is a great time to find a realtor partner for your pre-approved buyers, because remember, you need to give in order to receive. So if you want to get referrals from realtor partners, you got to give them referrals first. They're gonna love it when you're calling them up and say, "Hey, Jane, I have somebody uh, pre-approved for a $400,000 home. You think there's some $400,000 homes in your market there? You could find them." And Jane's gonna be thinking first, "Is there a catch to this? I mean, do I gotta pay?" No, and then you're gonna tell them, "No, I got my pre-approved buyer ready to go. Hold up a second. Let me send you his pre-approval. It says right there on the letter that I already checked credit, I checked assets, I checked income. I have an automated underwriting approval for my borrower. He's good to go." And they're gonna just love you for that, because I mean, very seldom does somebody call them and just give them a gift like that. Usually they got to pay referral companies. So again, another real important reason to get pre-approved or to get the borrower pre-approved is to have a more marketable commodity, both to be able to buy a home and for you to be able to refer your borrower. Because if you refer somebody not pre-approved, why would they want to work with your borrower? Then why would they even want to take your call again later? They're going to think that you're a joke if you're actually referring them in an unpre-approved borrower. So you do not want to be that MLO that does that and start your relationship with your realtor partners off on a bad foot. So items to consider when pre-approving the buyer. Right. So again, this is a little bit broad and general in nature here, because we could go on and on about this, and we will have specific trainings coming in the future on more specific loan types and stuff. But here, just to give you some general considerations, is you got to look at credit, right? What are your minimum credit score requirements? What are your minimum trade line requirements? Are there any disputed accounts? Because too often I'm meeting with teammates, going reviewing files with them, and they're all about the FICO score. But then all of a sudden we open up the credit, and they may have had an automated underwriting, approval, but they forgot to look and notice that it's a conventional loan, and they had disputed accounts. And if you read the small print in item number, I don't know, 31, 32, 28, 29, somewhere in those numbers on the credit section, it's going to tell you if you have any disputed accounts, you have to downgrade this approval to a manual underwrite. And you all know we don't have any manual underwriting options on conventional loans. So that borrower would have to take those disputed accounts out of a dispute status. You could all check in your credit simulation and see what would happen if you undispute the account. Sometimes doing so lowers the credit score. The underwriters know that. Fannie Mae, Freddie Mac know that. That's why they tell you to undispute the accounts and see what happens, right? On a FHA note, if you have disputed accounts, it's going to tell you if you have any of those disputed accounts where the sum total is $1,000 or over, then you have to downgrade your file to a manual underwrite, which means at that point now you have different DTIs, maximum 43% instead of 56.9%, excuse me, on the FHA. So would totally mess up your file if you just didn't look at some of these basic things. So again, know your credit, know your liabilities. It's not just about the FICO score. It's quick FICO score when you're just sending out quotes. But once you're getting into the meat and potatoes of the matter, you gotta dig deep. Don't be superficial about it. Don't be scared. Something else, income type. Now, this, we could go on forever on this one. This is a whole training unto itself. But again, we're going to consider income type, right? Are we looking at a full doc borrower? Are we looking at bank statement, profit and loss, DSCR? What type of income do we have? And that is going to determine then if we're going to be able to go conventional, FHA, VA, whatever, if they're a veteran. I mean, occupancy is another consideration, but here we're looking at income. So again, very important. So in the beginning, you may not know that your loan is going to be a DSCR, for example, because we cannot assume that the borrower does not qualify until we review income documentation, because by law we have to offer the borrower the lowest cost loan option, not the easy button. This is not about, oh, I want to go DSCR because it's the easy button. No. You got to go through the steps and review information. Now, mind you, if the borrower refuses to provide you tax returns or says, hey, I'm not filing this year, I'm not going to file this year, I didn't file last year, I'm in war with the IRS, my accountant and my attorney are dealing with it, I don't want to deal with any tax return type loans, then obviously you're not going to go full doc, right? You're going to go alternative options there: bank statement, P&L, DSCR, asset utilization, asset depletion, CDFI no ratio. If it's a primary or second home, that's the loan that allows us to qualify a borrower primary second home with no income or job verification. So really good product there. But again, going back to income, you got to do a thorough analysis of everything. Something else that people don't consider. Now, you may not necessarily consider this up front when you're pre-approving the borrower, but you're certainly going to consider this once they may have a property that they point out to you, and they may tell you, hey, Jose, am I pre-approved for that property right there, that address? Because I always tell my borrowers, once you find a property or 2 or 3 or 4 or 5, send them over my way so I could plug them into the formula, and I could use some real tax numbers. I'll get a quote from the insurance agent that I use that gives me quotes within minutes, or maybe an online quote service if it's in a state that we can obtain online insurance quotes, right? But once you get that property address, you can do a little bit of research, quick research, pop into public records and see if the seller is flipping the property. That's real important. That's one that can get you all the time if you don't look into it, because in some loan types, buying a flip presents issues. If it's a flip within 3 months or flip within 3 months. Were you going to ask something?
I was going to say we have that in the CRM. So when you put the address in our quote system there, guys, it'll always check the public records for you. And it'll put that on the disclosures, but it's also a tab on the quote. So make sure you check that tab for that exact reason that Jose just mentioned.
Awesome. Yeah, I just had it come up in a deal. The seller had bought the property only a month before, did a fixed flip, bought it with a fixed flip loan, and was reselling it. So depending on where we're submitting the loan, it may be an issue or it may not be an issue. Most of the time it is, but we do have investors that'll do the flip loan on a business purpose loan, which is DSCR, closing in an entity, and won't have any issues if it's a flip. But then most of the other ones do. And some of them will not do it at all. And some will say, hey, you know what? That may require a second appraisal if the percentage of profit is over a certain amount. And it's usually, if it's over 20%, then they're usually going to require a second appraisal if the seller is selling the property for 20% more than what he bought it for, regardless of the profit. They're just looking at purchase price that they bought it for, sale price. If it's more than 20%, usually that's second appraisal. Now, again, these are generalities that I'm making here. These are investor specific guidelines, like I like to say. So make sure that you do review the guidelines for the program. Not so much of an issue with Fannie, but it is still an issue. And with FHA is an issue. FHA has a 90-day rule. You can't even enter into the contract until the 91st day that the seller uh, gained title to that property. You cannot enter into a purchase agreement. So keep that in mind when you're doing those scenario reviews. And again, another consideration is the assets of the borrower, the funds that they're going to have available for the transaction. Where are they coming from, right? Are they already in their account? Are they going to be a gift? Are gifts allowed for the program type that you're looking at? How are the gifts going to be transferred? These are all considerations where you have to assist your borrower so they don't mess up. So if you know that it can't be a cash gift, make sure you tell them it can't be a cash gift. Tell your family member to give you a check or to send a wire so you can easily trace it back to the donor. Because, for example, on a conventional loan, you just have to be able to identify who the donor was clearly in the transaction. But in an FHA, you actually need to show the money leaving the donor's account. So that means you're going to have to show the transaction history of the donor's account with the money leaving and the transaction history of the recipient's account with the money going in. So again, now if it's cash, makes it a little bit more difficult, but if the amount matches exactly, on that, then the cash itself would not be an issue. Cash is going to be an issue if you can't identify who gave the cash, but still, you always got to look deep into that because it's probably going to require additional supporting documentation, even if you have all the paper trail, if it is cash. So make sure you dig deep into your guidelines and to see what are all the requirements to be able to properly vet that. So what are the benefits of being pre-approved? Again, these are, pretty obvious, right? You're going to have a better chance of getting your offers accepted, less time wasted by everybody, right? Now, here's something you may not have considered, but very important, again, in sustainability of your career, right? Is the overall home buying experience will be a lot more positive for that borrower, and the satisfied and happy borrower is going to refer more deals. If you hit the nail on the head and we're on point in your pre-approval and everything goes smoothly, then your borrower is going to be so much happier with you as their MLO. So what are some of the considerations to consider for a conventional pre-approval? So here I'm going to break it down a little bit more detail. Again, AUS approve eligible if it's DU and accept if it's LP is a must, absolute must to issue the pre-approval letter. We at the Mortgage Calculator will never, ever issue a pre-approval letter for an agency loan. Agency is conventional, FHA, USDA, and VA. We will never issue a pre-approval letter unless we have AUS approval. That is the first step. And we don't run AUS unless we have complete documentation to back up what we are running. So when you are running those loan scenarios, remember that MI is required above 80% LTV unless it's a combo loan. The reason I say this is because you may theoretically be able to pre-approve a buyer with a 620 credit score on a conventional loan at a 95% LTV, assuming you can get a rate that's in compliance, but you still need to get mortgage insurance. So you keep that in mind. If in doubt, if that credit may have some issues, you may want to reach out to your MI carrier, discuss it with your MI carrier account executive and find out, or your account executive from where you're considering sending that loan, if they do the MI, and make sure that you're not going to have any pitfalls being able to get mortgage insurance for that loan. Because I have seen that happen. You get the approval, and then MI won't approve it, and MI doesn't care what DU says. Conventional pre-approvals, again, this is obvious, but sometimes you got to restate the obvious, because it's not the first time that I've had an MLO call me on a non-QM loan that they keep getting an error. They can't figure out how to run DU because it's not applicable. But it's the opposite here in conventional loans. They're always full doc, and again, always AUS. Check the AUS for the trade line requirements, because sometimes that's what it's gonna boil down to. Look at your findings, right? Look at the findings in the AUS pre-approval, because your findings will turn into your loan conditions once that file is officially submitted to underwriting. So findings are your conditions. I'm not saying there are not going to be additional conditions, because when underwriters review the documentation provided, they may say, hey, this bank statement, you get a large deposit, or things that they may point out. But look at the findings in your pre-approval. Assets need to be verified on conventional loans. They need to be sourced. You need to know where it came from. And depending the asset type in the transaction, they also need to be seasoned most of the time. Now, again, you got to look at your AUS findings for assets as well, because the findings in your, I'm going to say DU, because some people may say, what's AUS? So I'm not going to confuse you. We'll use DU for now. The findings in your DU are your conditions. They tell you everything, and it'll tell you if you need 2 months bank statements. It'll tell you if you need 1 month bank statements, or it'll tell you if you don't need to verify any assets because they just love the deal so much. They'll take it at face value, right? It'll also let you know if you got to come up with 2 years tax returns, 1 year tax return, 1 year W-2, and 30 days pay stubs. I mean, it's a whole combination of things that you never really know until you load the information up in your LOS and you submit to DU to see what DU thinks about it. Because it could look perfect to us. We're looking at a 670 credit score. Yeah, 620 is the minimum. And it's looking good, and you're trying to get that 95%, and all of a sudden there's just something in that file that the DU algorithm does not like. So that is absolutely why we need to run every single agency deal through AUS before issuing a pre-approval, because it's not the first time that somebody's looked in manually, oh yeah, your DTI is 33 over 44, or 33 over 48, whatever. We can usually get 49.99, and they're making assumptions, because to get above a 45%, you usually need a 700 plus credit score when you're going 95% LTV on a conventional loan, right? But they'll do that manual pre-qualification, send it out, and then when it comes back and they're running DU, they're like, oh my God, I can't get it to approve it. And all of a sudden you get the approval eligible at 80% instead of 95. Time to run, right? Time to find a donor, get some more money, or you lose the deal. So more reason why. That's why whenever any of my team asks me, but why don't we do pre-qualifications? We see that some other people do pre-qualifications. I'm like, because we want to have satisfied customers. We want to have satisfied referral partners. We want to hold ourselves at a higher level than those other people. That's just the way we like to do it. We like to be consultants. We like to be professionals. We like to differentiate ourselves from the masses. And at the same time, need I say that it's going to allow you to have a more pleasant experience as an MLO, because when people view you as the consummate professional, they're less likely to question some other factors of the transaction, like the fees, right? We don't set the fees, right? The fees are set by the rate, but they always think that we set the fees, and they're always looking at the fees. So I like to give them a reason to look at me other than just think that I'm going to be the cheapest. No, I like them to look at me, and I like them to look at our team to think that we're going to be the best value for the money, right? the best value for the money. Like, we're worth it. I mean, you can either go to McDonald's, to get the burger, or you can go to the nice restaurant and get that nice hand formed 10-ounce patty like I like to get, for a little bit more money, not much more money, but much more satisfying. I'm gladly paying a couple dollars more to get a lot more of a satisfactory experience from my burger. And, simple example, but the same definitely holds true when it is the largest financial transaction that anybody is going to do usually in their life. Do you think they're not going to mind paying for the service that they're going to get as long as they think it's worth it? More reason why to get the pre-approval. And on our non-QM pre-approval, again, it's a little bit of I need to state it because I get the question. It's always manually underwritten, right? You are the DU, you are the filter, right? You have to look at the guidelines and make sure what is applicable and what is not applicable. You got to review everything that we've just discussed here: income, asset, credit docs, reconcile that to loan guidelines, and make sure that it fits. And once you've made sure that it fits, only after thoroughly reviewing all the guidelines, after thoroughly reviewing credit, trade lines, looking for disputed accounts, looking for how they're actually handling their credit, looking for 30, 60, 90-day late, looking for collections, charge-offs. Were they 12 months ago? Were they 24 months ago? All the different considerations that you have to give for non-QM loans. And only then what can you issue that pre-approval letter. And the pre-approval letter, we have some really good letters in our templates for non-QM pre-approvals. Which leads me here to the final point here when we're talking about non-QM pre-approvals. One that Nick knows that I love is those DSCR pre-approvals, because the DSCR pre-approvals almost allow your borrowers to compete well against cash buyers. You just have to know how to approach the listing agent who you are sending that pre-approval for, and basically feed into their ego.
We'll have to do like a role play tomorrow with that.
Yeah, feed into their ego, because remember, they're the listing agent, right? They know how much the property rents for, and that's the only income consideration. They know what the property is worth also as far as an appraisal, so they're going to have a good idea if you're going to be above or not appraised value. But the usual considerations is normally the income of the borrower, delays caused by requesting tax transcripts and other things like that. That as a DSCR borrower, you don't have those restrictions. So I'm basically putting the ball into the listing agent's court when I am sending them the DSCR pre-approval, and I let them know that way. It's your decision to know if this is going to close or not, because here's the deal right here. Nothing else to consider except my borrower's credit, and it's 782. The assets are in the bank, and if they ask for additional vetting, we can discuss with the borrower releasing some additional information to them, blacking out any private information so that they can know, hey, the score is 782. The proof of funds show $280,000 in the bank. It's a DSCR loan. He's pre-approved. What are you waiting for? There's nothing that's going to kill the deal other than that. So throw the mic down on that one.
So yeah, we'll pick this up tomorrow, I guess,
Yes.
on some more advanced topics.
Yes.
We got a couple questions here. Let's bring these in. So Saba had a good point here first. This is a good point here, Jose. What could happen if you don't do this, I guess. So Saba said they just lost a client that lost their earnest money from a pre-qual. So can you explain a little bit how that would happen, Jose? Exactly.
Well, I mean, I guess I'd have to know exactly what a little bit more context to what actually they were running around with. But it looks like they did not review docs. It looks like they just probably relied on a verbal representation of the information. Maybe they pulled credit sometimes that's usually the only thing that they do, if anything. But everything else is a verbal representation of the information. And then once you get actual documents, you realize it's a nothing burger. There's nothing there. So again, more reason why when you're speaking with your realtor partners, emphasize the thoroughness of our pre-approval process. They're going to love you for it.
And we'll talk about dates later, but remember, earnest money is a date thing, right? So we want to make sure we advise our clients to get everything set before we go hard, as we call it, when the earnest money is non-refundable, right? So we're not going to talk about that now because we're talking about pre-contract, but once we're in contract, we definitely need to pay attention to those things, and it sounds like that's what happened here. And Mike has a question here. Pretty long one. When the property address is TBD and the lender has not been selected, but the customer needs a letter, how does that affect the process? That's exactly what we're talking about here, Mike. Pre-approval means no address, right? So that's basically what we're talking about here.
Well, what I'd like to first state is that in most of these cases, we're the lender. And we have the investors who we sell the loans to after they close, right? But again, you're going to review guidelines. I mean, it's everything, like Nick said, everything that we just went through. You're going to review guidelines. You're going to review everything. And you're going to revet the deal after you get an address, like I was mentioning earlier, to then confirm, okay, you got an exact tax amount, you can get an exact insurance amount, you're going to look at seasoning on title of the current owner to make sure it's not a flip, things like that. But all the other stuff, you're just going to run through the checklist.
So to put it short, guys, remember, we do the entire loan for a pre-approval. We do the entire loan again once we have an address, but we've already done most of the work, right? All we're doing is fixing the address specific items. So we do a 100% start to finish loan, 100% done, the same exact loan as if we had an address before we have an address. And then once we have an address, we do the same exact process, 100% start to finish loan. It should match up pretty close. But as Jose said, we'll have an exact figure the second time around with an address.
And that's not a waste of time for those of you that may be out there thinking, oh my God, that's a lot of work, not knowing if you're going to get the deal. Well, you have to visualize success to succeed, right? I'm looking at my bar. I'm visualizing the closing already. They're feeling it. They're feeling how into it I am, how empathetic I am in the deal. They're not going away from me. Once somebody feels that commitment from you, they're not going to leave you for somebody else, and they're going to send you everybody that they can.
We got one more question here from Jason.
Real quick, I wanted to touch on that. A real point of what a waste of time is for your borrower and your realtor partner to be driving around for weeks looking at homes based on your pre-qualification that you didn't actually pre-approve them with. See how much of a waste of time that your client and realtor feel like it is at that point, right?
If you didn't take the hour to review the file and they spent multiple months. Some of my clients have been shopping for 3 years. I just did a deal for a guy that's been shopping for 3 years. Ever since proverbial stuff hit the fan, right? He's been shopping, and we finally got one. Finally. But let's bring back the question here from Jason. So how do the pre-approvals differ for broker, basically commercial loans, when we are not the lender and we're working with a commercial outlet that's going to actually do the loan here? Jose, it's a good question.
I mean, the overall concept of what the pre-approval is does not change. You are vetting the borrower in all of those different facets that I mentioned. You just have to take into consideration the guidelines that you're reconciling to. That's all that's real. The only thing that changes is, are you using A's guidelines, B's guidelines, C? A could be a commercial conduit. Okay, it's a commercial loan. They have their guidelines. It's just guideline interpretation, and then the just looking at it in a real world situation, applying it to your buyer. Nothing changes. You don't make anything up. You are just following the guidelines.
All right. And Christina's just asking if we leave the address empty. Yes, an address would be empty. And Ben, yeah, these are more procedural questions, guys. And some comments here. Okay. Yeah, I don't think we have. Those are a little more specific. We'll go over some more of the next steps here on the next one, I think, Jose. I think that's all the questions that'll be applicable for today. So, yeah.
Yeah, I think that we'll continue this tomorrow, Wednesday, 7 p.m. Eastern time. Again, we do these every Tuesday and Wednesday, 7 p.m. Eastern time. So definitely check us out tomorrow. And of course, we have our daily mortgage rates live that we do every morning at 11 a.m. Eastern. So I recommend everybody tune into that as well, where we go over live rates and we do a deep dive into a different topic every day. But we will be right back here tomorrow, going a little bit more in depth into this same topic.
Yep. Bring your scenarios tomorrow.
Yeah, feel free to drop some scenarios in the chat. Get some questions ready. We'll be talking about the same stuff here.
All right. Have a good night, everybody.
Take care, everyone.
Everybody.